Today's broadcast is on data-driven market analysis. Neal also calls it the location magic. So I also may have called this as a magic show at 7 p.m. Eastern tonight. So quickly, a couple of housekeeping stuff that we might have to do. Everyone is going to be on mute and automatically does by the host in the webinar, except for the host and panelists. Any issues that you may have with audiovisual, please type it in the chat box and I'll take care of that. Please locate the Q&A box and use that for question and answers. And we ask you to hold your Q&A till the end. We'll absolutely make sure that there are questions answered towards the end of the thing. And to avoid it, this webinar will be recorded and sent to all of you who have registered for the webinar. And just make sure that you whitelist my email. That's raj@smartcapitalmgmt.com. Just a quick disclaimer, the webinar is for education purposes only and should not be considered as any legal or accounting or investment advice. This information in the document does not, it's not soliciting any kind of sale or purchase of security. And please consult your own attorney, your tax guy, or your lawyer to make any investment decisions. This is not an advice, like I said in the beginning. A quick background on me, the host. I am Raj Tekchandani. I'm undergrad in computer science, and I've done a MBA also in high tech from Northeastern here in Boston. I worked at tech startups most of my career, and I have a passion for leveraging data analytics and making use of data. I bought my first condo in 2012 in Orlando, and then followed by more condo purchases, and then I bought a multifamily. My first passive investments was in 2016, and then I've done more passive investments and more active investment as well. I was invited as a host, guest on a podcast, a number of podcasts. And I published some ebooks and recently published an email course called The 8 Pieces of Pie. That's all available on our website, www.smartcapitalmgmt.com. A little bit about our guest. I can go on and on, but I think we should do minimalistic introduction. Our guest is Neal Bawa, also known in the real estate circles as the mad scientist of multifamily, and you'll know why. And he is a very entertaining speaker. I get every opportunity to listen to Neal, and it never gets old. He's so entertaining. He's a data guru, a process freak, and an outsourcing expert. And I was thinking, I could even mix those terms. He could be a process guru, an outsourcing freak, or a data expert.
Jambalaya.
Yeah, it's a jambalaya.
The rice with the beans.
Yeah. And Neal's portfolio about I'm just going to cover this, $200 million of multifamily. He lives by, and he's always experimenting with optimization and efficiencies around his portfolio. Neal lives by his 2 mantras. We can only manage what we can measure, perfectly right. And data beats gut feel by a million miles. So true, Neal, so true. And he uses his mantra to make tons of investors happy through his 500 plus investors in great returns for them. With all that said, I'm sure Neal has more to add, but I'm going to pass it on to you, Neal, and I'm going to stop sharing my screen so you can take over the magic show.
Thank you. Thanks so much, Rajesh. Give me a second. I'll share my screen. There we go. And welcome everyone to Location Magic. This is a ever-developing course about how you can use data and analytics to find the best cities and the best neighborhoods in the US for real estate investing. It's also about a mindset. It's about having a methodology. It's about having discipline to invest in certain areas and not invest in other areas. And Location Magic was formulated over the last 7 or 8 years through various experiments that I've conducted. So what you're looking at is about the 5% of Location Magic that worked, because the remaining 90% was a total and utter disaster and a failure. But that 5% I think was worth the remaining 90%. We've already done a disclaimer, and Rajesh has told you quite a bit about me. So all I want to mention is what I do in terms of the types of units. I do multifamily, student housing, and public storage. About 5,000 people a year take the course that you're going to take today. You're going to take part 1 of this particular course. These are the sort of properties I buy and build. I actually happen to have Rajesh as my partner in one of my properties. That's this one here, Park Canyon It's 151 unit that we're extending by 29 units. So it'll be 180 units in a couple months. We've already done a disclaimer, so I don't need to do that again. So let's get started. The location matching system is 5 real focuses to pick cities, and it's 5 additional real focuses to pick neighborhoods. These real focuses were formulated by using a statistical analysis software called R and creating a hypothesis. And I had lots of different hypotheses and then running them on a database of 3,000 US cities. My goal was to figure out what are the metrics that most closely match your pocket, the money that you make, the bundles and bundles of money that you can make in real estate. What are the metrics that match that the most? And what are the metrics that are consistently matching that, regardless of the size of the city, the location of the city, the part of the US? What are the ones that are consistent across the board? And I found metrics, 5 metrics that work about 95% of the time. The remaining 5% that they don't work in is usually extremely expensive areas. They don't work in Malibu. They don't work in Beverly Hills. They don't work in downtown San Francisco or downtown New York, but they work pretty much the rest of the time. So keep that in mind. Real focus 1 is population growth. And it's not enough to just say population growth. That doesn't mean anything. It's completely worthless. What matters is how much population growth over what amount of time. So we used our statistical analysis software and we looked at lots of different time frames in lots of different cities, big cities, small time, short time frames, long time frames, and we came up with this number, right? And this number is not magic, really. It's a guide, and it should be used as a guide. And sometimes I feel hesitant about using the word real focus instead of saying, rules of thumb, right? That's really what these are, because there's going to be in cases where they don't work, but the vast majority of the time you'll find that they'll lead you in the right direction. So we've divided cities in the US into pieces. The vast majority of cities that you would want to invest in the US are between 250,000 and 1 million people in population. That's like the vast majority of the investable real estate universe. For those cities, you want this much population growth, 21.25% population growth between the year 2000, that's our benchmark year, and the year 2017. Now, immediately, the moment I say that, the chat box, people start popping in questions like, but we're in 2020. Why do you put in 2017? The answer is that 2017 is the last available year that's available for free. And I wanted to make sure that my course was all of the data was available for free. Now, you can go and buy that data from a web vendor called Local Market Monitor, another vendor called Neighborhood Scout, and they will give you 2019 data, so usually a year out of sync. What I found, though, was when I was doing statistical analysis using the free data that was 3 years old and the paid data that was 1 year old, I ended up with the same list of cities every time. Not one time did I end up with a different set of cities because I was using data that's 3 years old versus 1 year. So I came up with another rule of thumb that's not part of the real focuses, and that is cities don't change over years. They change over decades. So the fact that the data is 3 years old doesn't really matter. Feel free to buy a subscription from neighborhoodscout.com or localmarketmonitor.com, but you're going to end up with the same list of cities. So you might as well use this data. So these 17 years, we're looking at 21.25% population growth. Now, if the population growth is higher than that, it doesn't make the city any better. So think of this as a cutoff, as a threshold. Above that, if there's 2 cities and one has a 30% population growth and one has a 40%, I wouldn't necessarily go with the one that's 40. I'd look at other factors. So once you're beyond the threshold, you're good. Now, what if your city is really large, like Los Angeles? Well, in that case, those cities tend to grow slower because they're huge. So I've given you a smaller number for that over that same 17-year time frame, 15%. What if the city is really, really tiny? It's less than 250,000 people. The city I live in, Fremont, is about 213,000 people. Well, for those cities, you have to bump up the number because smaller cities should grow faster, and you should get more growth because you're taking a higher level of risk. Because you're investing in a small city, your risk level is higher, your return should be higher. So look for that 30% growth level. The next thing I want to tell you is, what do you want to do next year, right? So in 2021, I want you to bump up this number by 1.25%. By the way, you don't have to write anything down. Everything that I'm going to give you, this whole PowerPoint deck, the Excel spreadsheet, everyone's going to get that. So you don't need to write that down at all. Feel free to write it if you want to, but I want to make it easy. So this cheat sheet that's on the screen is going to be in your mailboxes soon. So next year, we're going to add 1.25%. Now, as it happens, because of coronavirus, I might change that number just for 2021, and then in 2022, I might go back to 1.25%. And so I will show you a place where you can get access to this data, and I update it twice a year, so I'll send you a new version 2 times in a year, right, as I'm constantly tweaking this. So that's Real Focus 1. Now, where do you find Real Focus 1, right? It's one thing to see it on a slide, but you want to actually go and use this data, right? So what you do is you just go to Google and you type in population space, whatever city you're using. I use Columbus, Ohio for my examples, not because it's the best city in the world to invest in, but just because I wanted to use a Rust Belt city. I didn't want to use a superstar city like New York or Los Angeles or Seattle. I wanted to use something that was fairly inexpensive and was in a part of the country that hasn't done well in the last 30 years. So the state of Ohio hasn't really done well in the last 30 years. So I used Columbus for my example. So this is not an endorsement of Columbus, though I think it's a pretty decent city. So immediately, the moment you type in population Columbus, Ohio, and you see this graph from Google, you can already, you've learned something very critical here. This is something that you should be in the habit of doing. Every time somebody tells you about a certain city, you know, how's Corpus Christi for investment? How's Augusta, Georgia? The first thing you should do is, boom, population space Augusta, Georgia, population space Corpus Christi. You'll immediately learn new things. And you'll actually learn about other cities that may be better than your city. So if I ran this search by saying population space Cincinnati, it's going to give me the same graph, but I'm going to immediately notice, ooh, Columbus grows a lot faster than Cincinnati, right? And you notice that the other 2 cities are in the same state, and they're great cities of America, Cleveland and Cincinnati. But notice Cleveland actually is not as great a city as Cincinnati. Why? Well, Cincinnati is kind of the steady eddy. Maybe there's some population loss, but you notice that it doesn't react much to recessions. You know, it's very, very steady, and now it's kind of flattening out. But you look at what happens to Cleveland every time there's a recession, right there, recession. You see here, recession. When recessions happen, people run away from Cleveland. So the people that live in Cleveland are not as attached to Cleveland as people are to Cincinnati. So that's one thing to remember. Now look at where they run to. The people that are running away from Cleveland, guess where they're going? They're going to Columbus. Columbus is a couple hundred miles away. And so Columbus is a sticky city. What that means is when bad times happen, Columbus gains population from all the other places around it. Those people come in and then they stick with Columbus. Notice that after the recession ends, this doesn't go down. So Columbus doesn't lose those people. They come in, they like Columbus, and then they stick with Columbus. All of those things you learn from just one free graph. And it's a huge amount of information from you because, as you can already tell, it's a lot easier to make money in Columbus than it is to make money in Cleveland, simply because of the population going up and creating competition for rental homes that you are buying. Now, there are 2 numbers that are important here. If I mouse over to the right, oops, we just switched from 2017 to 2018. So I have an update to do on my numbers. So the number on the right is 2018. So you want to write that number down. And then you want to scroll to the left until you get to 2000. Now you've got 2 numbers, right? So all you have to do is plug these numbers into an Excel spreadsheet, which all of you are going to have today, by the way. And so you plug in the 2000 number, you plug in now it's going to be 2018. I'm going to update this spreadsheet. And now what you want to do is you want that number, this number here, which is auto-calculated by Excel, to be higher than the 21.25 number that I gave you. See this number here? I gave you this number. I want it to be higher than that. What happens if it's a little bit lower? What if it's a quarter point lower or 1 point lower? No big deal. As long as it's very close, you're okay. Don't try to be ridiculously literal with these rules of thumbs. Okay, so that's very important. All right, so clearly from a population growth perspective or Real Focus 1 perspective, Columbus gets thumbs up because it's above that threshold. Even if I was to take the 2018 number and bounce this up a little bit, it would still be green. So we're doing well on Real Focus 1, right? Now we're going to go, and by the way, there's many cities in the US that you might think of as great cities in America. I think of Detroit as a great city of America. It was the 2nd largest city in America in the year 1960, but take a look at what Detroit looks like. Right? So cities change over time. Some are great, some are greater. And it's very important for you to know this. And I'm giving you a 10-minute toolkit that makes you figure out which city makes more sense than the other. All right. Real Focus number 2 is, here we go. is median household income. So you want the median household income in whatever city you're looking to invest in to grow by at least 31.5% between the year 2000 and the year 2017. Once again, we're using a benchmark year, which is 2000. We've had recessions, two recessions since then, and a third one going on now. So I think that's a good benchmark year. And then 2017, which is the latest year that city data has data on. Now this one applies to cities of all sizes. So it doesn't matter if it's Los Angeles or Dalton, Georgia, this number applies. And then next year, you're going to add, sorry, this should be 1.5%, so there's a little typo here, 1.5% to this 31.5% number. So next year, in 2021, you're going to go with 33%. And once again, because of the coronavirus being so unusual, I might play with that number a little bit. So you might see an email from me 6 months from now saying, hey, for 2020, 2021, do this, and then go back on track starting 2022. All right. So where do you get this number? Well, it's really, really simple. There's a website called City Dash Data. Everyone forgets the dash part, so make sure you don't do that. So I went to that city, I typed in Columbus, Ohio, and it gave me this page. So I start scrolling down past all the ads and the pictures, and I come to this area, which shows me the estimated median household income in the year 2017. And it also provides me the income in 2000. So I've got both of my numbers. So the median income in Columbus was 37,000 and change in 2000. In 2017, it had increased to 51,000. So now I've got two numbers, and I've got an Excel spreadsheet. I go in there, I plug in the 2000 number, I plug in the 2017 number, bingo, 36%. Is that good? Yes. Notice the spreadsheet automatically switches to the color green. It's giving you a thumbs up because remember what the rule was? The rule was 31.5%. So now Columbus is above that threshold level for the year 2020, and it's a strong city that you should consider investing in based on that second number. Now, here's the third real focus. You want to invest in a city where median house and condo value is going up faster than that income growth, faster than that population growth, because that's when you create a lot of competition. There's a lot of people fighting over that same property, and when they're fighting, and they are your renters. They're the people that say, fine, I can't buy, I'm going to rent. So you want that growth in median household income to be so fast that there are constantly some people dropping out of the buying market and going into the rental market because those are your buddies, those are your friends. All right, so this one applies to cities of all sizes. So it doesn't really matter if it's, Los Angeles or if it's Dalton, Georgia, it applies to all of them. And next year, you're going to add 2.5% to this growth number, right? So when you use this system in 2021, you're going to add a 2.5% growth number in median house and condo value. Where do you find this data? Well, remember that city data page that we were on a few minutes ago? And we were on estimated median household income. Well, go down 2 inches, estimated median house or condo value in 2017. And you notice it's 99,100 in the year 2000, and it got bumped up to 151,000 in the year 2017. We go back to our Excel spreadsheet, we plug in the two numbers, boom, boom, 53%, which is much higher than 42.5%. Columbus gets a third successive thumbs up. Well, what if Columbus, one of these was a bit low? So a lot of people ask me, Neil, should I only invest in cities that get 5 thumbs up on 5 real focuses? No. Generally, you want to get to 4, and you might take 3 if the 4th one was very close. What you don't want to do is invest in a city that only gets 2 out of 5. So you want 3 out of 5 with a 4th close miss. 5 out of 5 would be great, but you'll find that it's troublesome to find cities with 5 out of 5. So that's always been a challenge. So 4 out of 5 is okay. Let's see. Let's go back to real focus number 4, which is crime trend. But before I do that, I want to point out an example of why this is important, right? So it's like, Neil, show us, an example where this really mattered. It really made a huge difference. So what I'm going to do is I'm going to show you what this number, the estimated median or house or condo value, is for the city of Detroit over that same time frame. You notice here there's a 50% increase, right? So, you look at Detroit, great American city. Let's take a look to see what happened there. Right here, you notice that homes in Detroit were $62,000 in the year 2000. But today, they're $50,000. Just based on inflation, this number should have been over 100,000 in those 17 years. but Detroit is going the other way, right? And you notice the state of Michigan actually has a pretty good number, 155. It's just the city of Detroit that has challenges. So this is how bad it can be. Obviously, this is a worst case scenario example, and there's many good neighborhoods around Detroit that many people should consider investing in. But you see my point here. This is how simple it is to pick between really good cities and really tough cities to invest in. Now, does nobody make money in Detroit? No, plenty of people make money in Detroit. This isn't about making money. It's about making it simple to make money. You're trying to be as lazy an investor as you can be. Use data, be lazy, and get a better outcome with less amount of work over your whole time. That's what you're trying to do. There's plenty of people that are making money in Detroit. All right, let's go to real focus 4, which is crime. And it's not increase in crime. It's not decrease in crime. It's crime trend, right? So you want crime to be, the trend for crime to be decreasing over a significant amount of time. And you also want the most recent crime index number to be below 500 in the crime index table that is at city-data.com. That same website that we were on, that same page that we're on, we want the number to be below 500 and we want it to be decreasing from left to right. So let's take a look. Let's go back. We're going to go back to crime. And, oh, oops, we're going to go past this table. You see this table here? Crime rates in Detroit. Oh, this is Detroit. I'm going to go to Columbus. So let's go to Columbus. We can also take a look at Detroit. So here you see crime rates in Columbus by year. On the left, you've got 2005. On the right, you got 2018. And you got all these different categories, the murders, the rapes, the robberies, assaults, and burglaries. You're going to skip all of them. You're going to skip them all. And you're just going to go to this last line. You see this blue line here? You're going to look at the number on the left, and then you're going to look at the number on the right. And you're going to make sure that it's decreasing from left to right. What that means is crime is going down over time, which is great. Crime going down means property prices go up, rents go up, and salaries go up. Everything good happens when crime goes down in an area, right? And population is going up. So population up, crime down is this wonderful mishmash of things that create real estate profits. So you notice here there's been a huge decline, and also it's a pretty smooth decline in crime. So 686, 666, 621, 587, 561, 423, 406, 419 goes up a little, and then down to 375. So it's never going to be, this is always going to be a little bit bumpy, but this is what I define as a very smooth decrease in crime. And Columbus has seen a very sharp decrease in crime over time, and a number of cities are like that. Once again, crime is a table where I tend to be a little flexible as long as the trend is good. So Orlando right now, well, for last year was around 550, right? So it was above that 500 threshold. But I'm looking to invest in Orlando because the number was 800, right? 13 years ago. So Orlando was a very high crime city that's now going in the right direction, and it's moving in the right direction very, very fast. So in a couple of years, I'm guessing that it's going to be below 500. So no issues with investing in Orlando. But Memphis, I would have trouble investing into Memphis because the number on the right is going to be in the 700-800 range. Now, once again, doesn't mean that people don't make money in Memphis. Lots of people make money in Memphis. There's lots of deals in Memphis. The challenge is that when a recession hits, a city that has a high crime level is going to see a much higher level of delinquency than a city that has lower crime levels. So Boise, Idaho, which has a number of 214 as a crime index, it's the safest city in America, is going to have a lot less issues with delinquency, with break-ins, with crime during a recession. Remember, crime goes up a lot during a recession, right? So it's going to spike up in the next 6 months because we're now in a recession. That number spikes up a great deal in cities that are higher crime. So a place like Oakland, a place like Memphis, a place like St. Louis is going to see much, much higher delinquency related issues, crime related issues over the next 6 months than, let's say, a place like Boise, Idaho. So that's real focus 4, and we're talking about crime. And real focus 5 is jobs. But before I do that, I want to point out a couple things that are my sales pitch. So I use these numbers and many others, we're 4/10 of the way through, to both buy and build in areas that are absolutely phenomenal to buy and build in. And I spend hundreds, maybe thousands of hours every year to figure out where I should buy. So Mesa Arizona is a phenomenal city to invest in. Why? Because its primary city, Phoenix, look at this. Fastest growing US city, highest employment growth, best city for young professionals, fastest growing economy, largest data center market, best city for teleworking. How good is that for a post-corona world? Best places to live. And then Maricopa County, fastest growing county in the US, best charter schools, best employers, most innovative schools. All of those from the county and city level. But notice I'm not investing in Phoenix because Phoenix is expensive. What I do is I look at a best-in-class metro, and then I go into a 30-mile radius and I analyze the local areas, and I invest in those areas because now the cost is much lower. But I do look for best-in-class rent growth. So take a look at this rent growth, right? The US, look at the national average there, and then look at this for a Class A asset. Look at this for a Class C asset. I mean, these are remarkable numbers. So what I do is I build these kinds of assets. A mile in this direction, if you look at this road here, a mile in this direction are $2 billion data centers made by companies you've never heard of. I guarantee nobody's heard of Apple. No one's heard of Google. They're about a mile away, and you can actually go via bicycle to those places. I love data centers. They create an incredible amount of wealth in the local market. So those are examples of buildings that I'm building at this point in time with these kinds of projected returns, 25% annualized. I also like to help people get into the multifamily industry, and I do that by teaching a boot camp. So what you're getting is one 1-hour section of a 24-hour long boot camp. And the key is that the training is very tangible, it's very specific, it's very eye-opening. There's no upsell, no coaching, no mentoring, no tapes, no $20, $30, $50,000 product. You're in there for 100% sales-free training, and it's filled with ridiculous numbers of technology shortcuts that me and my team have discovered over time. You're going to find that we don't tell you go to LoopNet to find properties. We tell you do these 17 steps on LoopNet, find this guy. This guy has 80% of the properties in the US, right? Step by step, and there's 50 plus shortcuts in the bootcamp that you're going to use. So we talk about syndication, we talk about the best metros and neighborhoods, even in a deeper way. We talk about how to use technology to find brokers, how to use technology to find off-market properties, how to evaluate properties using artificial intelligence tools, how to use metrics and systems and dashboards to manage your property managers to the nth degree. We use ridiculously powerful dashboards. And then most importantly, how to use technology and marketing and digital marketing to raise private money. We've raised over $50 million of private money. So that bootcamp is at multifamilyu.com/bootcamp. We're an early bird, so you can take $500 off. It's only a couple $1,000s. We believe that the $20,000 and $50,000 products are good for some people, but not for everybody. Not everyone needs that level of hand-holding. And there should be a lower price $2,000 product for people that are fairly ready to go. So it started as an e-bootcamp. Obviously, no one's traveling at this point in time, but we started as an e-bootcamp, and that's what we're doing at this point. So it's in June. I also wanted to point out Multifamily U. This is a website that we have that has 50,000 people that come in every year to take webinars and seminars. So I'm doing a webinar tomorrow that has 1,200 people signed up for it. About 400, 500 will attend it. But my webinars are not as important as the webinars from these guys. There's all these, superstar people in the industry, and I've been lucky enough to work with them on projects, on many projects, and so I bring them in, and they do webinars. By the way, I'm not just doing projects in places like Durham, North Carolina, which was just ranked as one of the top 10 cities to invest in on a post-COVID environment. Why? Because it's a low-density city. It's fast-growing. Here's the Storage Depot, which is in Arkansas, not in Memphis. It's in West Memphis, which is a different city on the other side of the state line. And so we do self-storage projects as well. If you're interested in self-storage and why it's better than multifamily and other asset classes, come talk with us, and we'd be happy to talk with you about it. The last thing I wanted to mention before I move on to the real focus number 5 is how you get access to the Excel spreadsheet and this deck, and how do you get updates twice a year. So for that, you'll have to take out your phone and grab your phone and go ahead and do what's on this screen. So take a moment and send this word, RE Toolkit, no space. Your phone will try to add a space, to this number, 44222. When you do this, you're now subscribed, and I'll leave this on the screen for a minute, to my Real Estate Trends Toolkit. And we update the toolkit 4 times a year. We update the Real Focus rules twice a year. And the toolkit is extremely powerful, and it's way beyond just the Real Focus system. Let me show you what the toolkit looks like today. We just finished an update last week. So here's the toolkit. Give it a second. It's going to load. It's rather a large page, so it does take a little bit of time to load. So I'm going to go back for a second so you can see that text message again. Text the word RE Toolkit to 44222. If it prompts you, you're doing it right. If it gives you an error message, you're doing it wrong. Try again. All right. So here is what that page looks like, and we're constantly expanding it. Whoop. Slow today, aren't we? So I'll give it another second. There we go. There we go. That was just cached. So the Real Estate Trends Toolkit has sections. There's COVID-19 impact market report. So there's a dozen different reports. Well, actually, at this point, we've removed a few of them because they're outdated. As you can imagine, we have to remove COVID reports every month because this is a very fast-moving pandemic and a fast-moving recession. So there's 7 reports on COVID that you absolutely should read. And then because I live in the San Francisco Bay Area, there's a section for that. And then these are the top 10 cities that you should know about that are positioned to recover very quickly from COVID-19. I'm happy to say we do not invest in these 10. We invest in 5 of these 10. And again, a lot of that comes from knowing the data. These are trends videos that I've gathered for people that are talking about the impact of coronavirus. Assam Naji is a very, very smart man. He runs CBRE. And so very, very powerful. Oh, sorry, Marcus and Millichap, very, very smart guy. Listen to him. I've got Barbara Corcoran. I've got Ken McElroy, who was in the Rich Dad, Poor Dad book. And a lot of other powerful videos that are in here, US outlook and impact reports, affordability crisis, and so on. And then right here, this is where you will find the latest city comparison spreadsheet and the latest cheat sheet with the rules in them, more ranking reports, and trends articles that I think are very compelling, and then resources for those of you that are in multifamily, like cap rate trends. And then all of our webinars, and then there's about 100 podcasts that me and my partner Anna have been on. So all of those are inside the Real Estate Trends Toolkit. We're about to start adding infographics to the Trends Toolkit. So you get access to all of that by doing that thing that I just told you with the toolkit. All right, and that gives you access, by the way, to these spreadsheets as well. So now let's go over to Real Focus 5. Oops, I'm in the wrong place. Real Focus 5 is 12-month job growth. This is the most important of the 5 Real Focuses. People often ask me, Neal, does every Real Focus have the same weightage? The answer is no, though our Excel spreadsheet doesn't use weightages. Everyone needs to kind of play that depending on the area they're in. So I'd give 15, 15, 15, and 15% of weightage to the first 4 Real Focuses and 40% to this Real Focus. So it has a higher weightage. You're looking for areas, for cities, for metros that are above 2% annualized job growth, 2%. And if the cities are over 1 million people, like Los Angeles or New York, then you can bump it down to 1.5%. So Atlanta, Los Angeles, New York, 1.5 is just as good a number as 2% is for, let's say, a place like Mesa, Arizona. And this applies to all years. So next year, you're not going to add anything to 2%. You're not going to go to 2.1 or 2.2. You're just going to stay with 2%. And where do you find this data? Well, the government is in charge of making the ugliest websites on the planet, and they've outdone themselves with this website called departmentofnumbers.com. It's my favorite ugly website on the internet. So I'm going to go to the website, departmentofnumbers.com/employment/metro. So here it is, super ugly, right? So you look at this and go, really, this is a powerful website? Yep, this is actually the most powerful page for real estate investors on the World Wide Web. It's the most powerful page there. So I'm going to click on this row, because this row is really all that matters. I'm going to click on it, and now you have the worst places in America to invest in today. Now, Lake Charles is actually a good city to invest in. There's lots of great stuff going on there because of the petroleum pipeline that goes through. But for the moment, today, if you want to invest in Lake Charles, you're going to have a lot of problems. A 5% change in jobs often leads to a 10% decline in rent, and that's you want higher rents when you're investing. Unfortunately, I see cities in the same states over and over again. I see Louisiana, I see Illinois, I see Michigan, I see West Virginia, and Ohio. So a lot of these same states show up as the states that are the weakest in the U.S. I suggest you very strongly that you stay away from these kinds of places. Now, clicking once more on this column brings you to amazing magic. So here's what I want to give you. 2% in this column is good. Nothing wrong with those places, and you should invest. But what you're really looking for is where are the places that have 3% in job growth. When there's 3% in job growth, you don't get 3% rent growth. You often get 5, 6, 7, even 10% rent growth in cities that are 3%, because at 3% job growth, employers are fighting over people, and they're giving them raises, and those people are feeling good about it. There's a buzz in the city, and so everyone wants to buy real estate, and so prices of real estate go crazy. And then there's people who can't afford real estate, and they're still like, no, I want something nice, and I'm going to get Rajesh's unit that he just rehabbed, this beautiful property that he spent $6,000, $7,000, $8,000 per unit rehabbing. I'm going to go rent that property, and you're going to get huge rent increases at 3%. At 4% job growth, you're ordering cases of champagne bottles. At 5%, you're dancing naked in the street with your champagne bottles, right? That's how amazing 5% is, and you rarely ever hit 5% consistently. Now, you might say, but Neal, this is only a 1-month snapshot. Well, it's kind of a 12-month snapshot, but yes, you're right. It's only a 1-month snapshot. So you may want to use a website that I called the Wayback Machine. And you can go to Wayback Machine. This is the Internet Archive, and you can plug in this URL there, and it'll actually give you this job growth for every month going back, because I never want you to use these cities based on just one single snapshot. You want to take the snapshot for this month and the last month and the previous month, the month before that, and you want to see what cities are consistently in the top 20%. And you notice as I go down through this city list over the next 4 or 5 minutes, this is almost the end of my presentation, I'm going to pick certain cities and skip other cities. Why am I doing that? Because I don't see those cities at the top consistently. If I see them consistently, I'm going to mention them. If I don't, then I'm going to say, well, these are good cities to invest in, but you might want to watch them longer before you invest in them. So the first city that shows up in this list consistently, constantly, is St. George, Utah, the only warm part of Utah. A lot of rich Utahns buy second homes there. It's great for tourism. Obviously, it's going to suffer a little bit, but it's the kind of tourism that's outdoors. So indoor tourism of the sort that you see in Orlando, where there's 80,000 people in a park, is going to suffer a lot more than outdoor tourism, which is the kind you see in St. George, because a beautiful mountain range is about 10 miles away. So we invest in St. George, Utah. We are positive that our property will do that. Well, Kennewick, Washington is part of the Tri-Cities in Washington. It's about 200 miles southeast of Olympia. Beautiful place to invest in. I think it's going to do really, really well. Boise City, Idaho constantly shows up in this list. It's very expensive now, so the time to invest there may have passed. Coeur d'Alene, Idaho is not part of Idaho's economy. It's part of Spokane's economy in Washington. It's 20 miles away, and it serves as the place that rich Spokaneans go out to when they want to have fun. So it's a nice place to invest in. Madera, California is a city that's special to me because I own 10 single-family homes in Madera, California, all purchased in 2009 using this system or a version of this system. Provo, Utah is always in the top 10% of this list, a phenomenal city to invest in. Provo is the next Austin, so I highly recommend it for those of you that don't mind investing in Utah. Phoenix, Arizona, Bend, Oregon, Greeley, Colorado are commonly in this list. So is Salt Lake City. Those show up in the list as well. And then you start seeing some superstar cities like Denver and Austin. They're going to be there, but they're going to be expensive. So as you go down in the list towards the 2% mark, you still see some good cities here like Eugene, Oregon, Fort Collins, Colorado. Raleigh, North Carolina is a phenomenal city to invest in. So is Jacksonville, so is Colorado Springs. So these cities, notice I'm pointing out maybe 1 out of 2, 1 out of 3, because they're constantly in this list and they tend to stay above that 2% level. And then they bounce back and forth between 2 and 3, and in case of St. George, between 2 and 5. And so those are terrific, terrific cities to invest in if you're looking for job growth to drive your rents forward. Chattanooga, Tennessee, by the way, also a terrific city to invest in. A city that me and Rajesh are partners in is part of the Chattanooga metro. It's called Dalton, Georgia. It's about 20 miles away. So it's a suburb of Chattanooga, even though it's in the state of Georgia. So with that, we've come to the end of this presentation. And you might say, but that's only cities. Well, yeah, evil Rajesh only gave me 45 minutes. So I covered the cities portion. Now I want to cover the neighborhoods portion of this. So I'm going to tell you exactly where to go. So this is the part that you need to write down. So grab your pen and write down udemy.com. You don't need to worry about the course portion. So udemy.com/realfocus. Do you see this? udemy.com/realfocus. And you notice that there's right now 5,500 students taking this course. This is actually the most highly rated real estate course on Udemy. So these are 5,500 people. This number obviously changes constantly because students join in and then the students leave. And so you can go in here, the second portion of the course, which is neighborhoods. And I want to tell you it's more powerful. I just couldn't teach it first. It's more powerful because neighborhoods are what mattered. All great cities have shitty neighborhoods. Phoenix downtown, phenomenal. Mile and a half from Phoenix downtown is the Phoenix jail. The Phoenix jail, you wouldn't want to be there in that neighborhood after 5 o'clock. I tell you, you might end up with some extra metal lodged in your you-know-where, right? So neighborhoods are critical when it comes to real estate investing. So take the other half of the course. It is free. There's no strings attached. There's no pitch. It's not going to try to sell you anything. I don't have a paid product on Udemy. So check out udemy.com/realfocus and you can finish the rest of this course there. And hopefully you continue coming to Multifamily U for our webinars. And I'll load that on the page, and I'm happy to take your questions at this point in time.
Well, thank you, Neal. This was incredible. By the way, Neal, can you hear me? I just want to make sure the audio is.
Oh, yeah, I hear you.
Great, great. So I urge people on the call to enter their question in the Q&A box. We have already some questions that are ready here. If Neal, you're ready to answer them.
Yep. Well, I don't see them. I'm not sure. Okay, I see some in the chat.
Yeah, in the chat. Yeah.
Yes.
So anyway, some of them also had a question that I had asked people in my Facebook post this morning to send me.
Yep.
So one of the questions was, this formula that you showed us, right? How does it change post-COVID?
So there's a few things that you need to be aware of. The numbers don't change much. To be honest, there's no real reason for these numbers to change. But there are a few things that you need to be very aware of. Number one, this is not a good time to invest in places that are tourism driven, especially if it's international tourism. For example, Orlando, Florida is going to get hit a lot more because 40 or 50 million of its tourists come from other countries. They come from South America and they come from Europe. It's a well-known destination for international tourism. Whereas domestic tourism places like Coeur d'Alene may not get hit as much. A lot of people are saying, we want to do staycations. We want to do these short vacations where I'm not going to an airport. I don't want to fly, but I don't mind getting in my car and driving 4 hours. So I don't think Reno gets hit as badly as Orlando does. So stay away from those kinds of cities because they're not going to do well. Cities that are very dense, like New York and San Francisco, are going to do really poorly because we've already started seeing a desire for people to be in a lower density environment. So stay away from high density, at least for 1 year. Hopefully this mindset that people have is only short term and it goes away. Third, do not invest, at least for the next year. Be very careful investing in deep blue Democrat states. There are all kinds of measures underway to do rent basically to do rent holidays that are as long as 1 year in case of Chicago and 6 months in case of San Jose, California. There's a lot of measures, and then these cities are also looking to beat up us evil landlords by implementing more aggressive rent control. So the next year is wait and watch for expensive blue states. Raj knows this well because he's in a deep blue state. Massachusetts is known to be a very liberal state. So God knows what they're going to come up with, given their cap rates are already at 3, and the cap rates might go negative, right, when they do that. All kinds of bad things can happen. So this is actually a key time to be investing in business-friendly states. And by the way, that was not a political comment. I'm actually very agnostic. As far as I'm concerned, I have no interest in politics, but I have interest in knowing how politics affects your profits. And I can tell you, the next 12 months, it's much more likely that you'll make more money in Republican states that are very eager to reopen, even at the cost of human life, than you would in a liberal state. So be very, very careful. Those are that's my advice to you. So far, I can tell you that value-add projects have done really well, and Rajesh can actually, provide a testimonial there because he's involved with us in a property that for both the month of April and the month of May collected 100% of its rents. So, which is very unusual. Not all of our properties did that, but that particular property in Dalton, Georgia did do it. So we're doing well. Now, having said that, I'm not ready to declare victory. I believe that you will start to see an uptick in delinquency in the month of June, and an uptick in July, and an uptick in August, because it takes a while for people to run out of money in their banks. It takes a while for people, that check that came in from the government, it's only going to last for 1 month worth of rent, 2 months at the most, and then it's gone. And so we're going to see an increase in delinquency. So what's funny is this system that I just taught you actually protects you, because the neighborhood portion of the system focuses on delinquency. So what are the neighborhood real focuses? I'll give you a preview. Poverty level, right? Unemployment at a neighborhood level, income at a neighborhood level. When you're looking at those numbers, automatically by staying away from areas that have high poverty level, you're going to stay away from the COVID impact as well. So there's so many pieces of this real focus system that is almost designed for a post-COVID environment. Obviously, it was developed, in the last 10 years, so that wasn't our intent. But I think it works even better in today than it did 2 months ago.
Great. I'll take the easiest question first. Matthew, yes, we'll be sending out the recording. Don't worry about that. And the next question is from Shelly. Shelly is from my Boston local meetup group. She's a very, fond member, and she's always there on the front row. Shelly says, is there a metric that indicates if a city has become too expensive?
Yes.
It meets 4 out of the 5 real facts, but may not be, if the average home price is increased by 100% or more?
Right. So the short answer is accidentally you ended up with the right number. If the average home prices have gone over 100% in that time frame, that city may have become too expensive. Even 80% is a concern. So right now I have that concern for Denver, Colorado. I have that concern for Phoenix and Orlando, but Phoenix and Orlando have stronger job growth, right? So obviously a city can sustain a higher level of growth if the job growth is stronger. Where Denver's job growth is decent, but it doesn't justify a home price increase of well over 100%. So one of the ways to look at this is I'm going to throw something on the screen for you. So here's a cheat I want to show you. There's a guy named Ingo Windsor who writes an article for Forbes about home prices. Do you see this? Ingo Windsor home prices. Now, I want you to basically follow this guy, because what he does is he actually answers Shelley's question, where over time, what he does is he establishes these lists of cities that are overrated. And it's hard for me to find the article, but if you click on these 5 or 6 lists, you're going to find one of them where he says, this city has become really, really expensive because its income is here and its rents are already here and its home prices are already up there. So, right, so he looks at the discrepancy between a city's income level and where its home prices are. And he says, it's going to be hard for the city to go up further. It may not come down, But what you want when you're investing in a city is that after you go in there, it should go up. If it's already gone up a lot, then you lost out to the guy that sold the property to you. So Ingo comes up with those kinds of lists, and at the very top of his list of concerned, places where he's concerned about is Denver, Colorado.
All right, next question is from Stace. I know Stace as well from my meetup group. Stace says, is there a formula you use to find large city that underperforms, but has a satellite city that overperforms? Something that you mentioned in the webinar earlier, and that flyer.
I think so. I think the formula that you used is still active, but in that case, what you're doing is you're being more flexible on the 5 city real focuses for the main city. So a city that underperforms that has good satellite cities is Philadelphia. So you might want to look at Philly. And also you might want to look at Cincinnati. So I just showed you Cincinnati, and you notice that population growth was flat. But there are cities around Cincinnati that have been stealing population from Cincinnati. The same thing's happening with Philly, where its satellite cities are stealing population from it. Normally, satellites don't steal population from the main city. They sort of grow together, but that doesn't happen all the time. So the answer is, if you can be more flexible on the real focuses and be more tight on the satellites, I think you'll achieve a decent result.
Next is Avkash. Avkash says, how do you easily find out if the certain neighborhoods are landlord friendly?
Neighborhoods are not landlord friendly. Counties are. So the answer is, what you have to basically do is understand the county's rules, because a neighborhood has nothing to do with landlord friendliness. The eviction rules are formulated at a county level. So you can often in the same city have one part of the city that's landlord friendly and another part that is landlord unfriendly. That actually happens fairly often. And so what you have to do is understand how friendly the county is. And the way you do that is you call up 3 property managers in that city, and you ask them the question exactly the way that I have told you. Here's what you don't want to ask them. You don't want to say, is your city landlord friendly? The answer from every property manager in the world is yes. Even if they're in even if they're in San Francisco, they're going to give you all these examples of how San Francisco is very landlord friendly. So don't ask the question that way, right? They still have to make money. What you're going to say is, here are the 3 counties in your city. Which one of these 3 would you say is the most landlord friendly? And he's going to think about it, and then he's going to name one. And then immediately you're going to say, and out of these 3, which one do you think is least landlord friendly? Right? Don't ask the question, both parts of the question together. You're going to, he's going to bullshit you. So ask the question in 2 different parts, and now you've figured out what parts of the city are landlord friendly and what parts are not.
Great. Next one comes from Gaurav, and Gaurav says, when will you start looking for deals in multifamily area? I don't know if that's clear or not, but are they there now, or expect best ones in a few months from now?
We've never stopped looking, Gaurav, but the answer is that what we are doing at this point of time is we are making the assumption that prices are going to decline by 10%. They might decline a lot less. The stock market only seems to go up. I don't know why, but it only seems to go up. So they might decline less, but they're going to decline a bit because there have been some very aggressive restrictions placed on multifamily over the last few months by Fannie and Freddie. It's going to have some form of a short-term impact, most likely in the Q3 and Q4 of this year, and things will even out next year. So are we looking? Yes. But right now, if you make an offer, we make an offer at 10% under what we would have made an offer on the same property in February. So we're not winning anything. So we're not even close, because there's 1031 people that are still bidding the same price or maybe 5% less, so they're winning them. There's also very little inventory in the marketplace. So it's not like you have a lot of choice when you're buying multifamily. So what will happen is in Q3 of this year, both of those problems will get resolved. You'll see more properties come to market, and you'll see more sellers that have adjusted their mindset to the sort of price that is really needed today, which is 5 or 10% decline from where it was in Feb. So in my mind, I think Q3 would be a good time to buy. Q4 would be even better.
All right. As people, I still urge you to ask questions here. And the next one comes from Andrew. Andrew says, is the Fed's recent monetary policy affecting your investing strategy at all, Neal?
So much. I mean, the Fed is the 800-pound gorilla. So much so that my favorite webinar, and it's not the webinar that we have that's the most popular, but it's my favorite one, is tomorrow. Do you see this May 20th? You notice, is coronavirus the tipping point for our banking system, and how will it affect real estate? Well, this webinar is actually not about the coronavirus. The coronavirus is the trigger, but this webinar is about the Federal Reserve and what they're doing and how it's impacting the market. So this is for geeks. This is for geeks who want to understand things like, what does quantitative easing do to real estate? What do interest rate cuts do to real estate? How has that impacted the price of real estate? So the Fed's monetary policy is extraordinarily bullish for real estate in the long run. In the short term, short run, it really has no impact. Because if you notice in 2008, prices went down for single family 30%. For multifamily, they may have gone down about 15, 16%. But the Fed cut interest rates to zero then as well. So the Fed's monetary policy does not have a short-term benefit to real estate. We've never seen that. But it has an enormous long-term benefit. Because I'm not interested in investing for a 1 year, 2 year time frames. I am much happier with where real estate is today, because we had ended this run. Interest rates were flat or were going up. And so we had sort of ended the glorious run that we've had since 2012. In 2019 and 2020, it was like, okay, this is the end because the Fed's going to increase interest rates. Well, now we get another bounce. We get another 4 years of growth, which is awesome. And I just have to get through, and my portfolio has to get through the trouble that we're going to run into in the next 12 months. And so I'm just focused on getting over that hurdle. And to me, it's so much better to be a syndicator today than 4 months ago.
Great, thank you. Avkash has another question up here. It says, Neal, what are your top 3 cities you would invest in?
That's a hard one. So today, I would invest in Raleigh, North Carolina, Charlotte, North Carolina, and San Antonio, Texas. So obviously, a lot of personal liking goes in there. There's other factors at play there as well. But there's lots of great cities in the US, but those are my 3 personal favorites in 2020. Note that none of those 3 were my personal favorites for 2019. So it really sucks. I'd love to have one city that remains a favorite for like 5 years, so I wouldn't have to move around so much.
And I think this one question came earlier in the day, because when I asked for people to send me questions that they had in anticipation of the webinar. And Paul had said, I've seen this webinar or some form of this webinar before, and you mentioned a lot of free sources. What about, above those free sources, what does Neal and company use in terms of paid sources that could even improve more this magic?
Sure. Localmarketmonitor.com, housingalerts.net, and my favorite, neighborhoodscout.com. Right? Obviously, one level above that is CoStar. CoStar is very expensive. I think that CoStar is really for experienced indicators that know how to use it. So I would not recommend it. But neighborhoodscout.com is worth its weight in gold.
Excellent. So I think if that's all the questions, I know we are coming up to the top of the hour, and I know people's lives are busy. You have kids, families that are waiting for you, but I really appreciate you guys taking the time this evening. And Neal, really appreciate you being here and helping us, through all these bizarre times and questions that we have at this point. And please, I definitely recommend that Neal's, part 2 of the course that's on Udemy. I've seen it twice, still never gets old. I can always go back and, always learn from it every time I go back there. And watching Neal on different webinars and different, things that he puts out there. So really appreciate that. Thank you, Neal. And thank you, everybody, and have a wonderful night.
Thank you, Raj. Goodbye, everyone.
Hey, thanks. Sorry, I just ended the meeting so abruptly. I said, I didn't even say bye to you properly. So thank you so much, Neal. That was